Hey, Bob, great to chat with you. I want to talk about what we are seeing across the board in terms of sector action with the S&P closing at a fresh record today. But that wasn't the case across the board. We saw a little bit of pressure in tech. We saw utilities performing well. Do you think that there are certain sectors of the market that are kind of coming out of recessionary territory and others that are preparing for it? What do you make of the bifurcation?
Well, I think a lot of this comes down to the pricing. And when you look at what's priced into the tech side of the equity market, you have not only perfection, but some of the most incredible earnings outcomes that you could achieve. And so I think part of the story here on a forward-looking basis is that easing is going to help create a bit more breadth in the overall stock market. So those areas of the market that have been underperformers relative to mega cap growth companies are likely to see some benefit from an easing of financial conditions. And at the same time, those lofty expectations in the mega cap tech stocks are continually very challenging to meet on an ongoing basis. And so I think some cooling there relative to the rest of the market makes a lot of sense ahead.
Let me ask you, Bob, the Fed did deliver that supersized cut, and I think investors are trying to figure out what comes next year. What's the path and trajectory of cuts look like from here? What are you telling clients, Bob?
Well, I think the most important thing about that meeting was that Chairman Powell outlined the need to cut monetary policy ahead, and at the same time talked about those cuts in the context of a strong economy. And that combination of dynamics plus the speakers that we saw come out through the course of today suggests that the Fed is happy to cut interest rates even if the economy is strong. So it's not necessarily clear that you need a meaningful weakening of employment conditions over the course of the next 15 months to get the kind of cuts that the Fed has talked about. And the reason why that is the Fed believes that inflation is beat. It's no longer a concern. And so if it's no longer a concern, why maintain interest rates at this level when you can, cut interest rates and avoid even the smallest risk of an economic downturn?
Are you buying that call on inflation from the Fed, Bob?
Well, I think the way that measured inflation is reported, we're unlikely to see a meaningful shift in measured inflation over the course of the next year or plus. And I think that's a very interesting dynamic, which is that to the extent that the Fed delivers accommodative policy into a reasonably healthy economy, that's likely to create inflationary pressures ahead. We're already seeing it to some extent in seeing wages start to pop up a little bit by very timely measures. But the problem is that will not flow through to measured inflation rates until 12, 15, 24 months from now. And so the Fed is going to juice the economy here and probably juice asset prices, but won't suffer the consequences in the reported data until, considerably ahead. And so that creates this period of time where there's the risk that the Fed is too easy relative to underlying conditions.